The Fed announced today it's leaving interest rates unchanged and it's buying $65 billion worth of bonds a month, down from $75 billion. Bill Irving from Fidelity, what's your reaction?
Well, I would say that this statement had no major surprises. I would make 4 points about it. First, as you said, we got a further $10 billion reduction in the pace of asset purchases, equally split between treasuries and agency mortgage-backed securities. Second, I would note that I would say they upgraded their outlook for the economy, noting that in recent quarters, GDP growth has been a little bit faster, and the fiscal headwinds have been fading. Third, I would say they made no change to their forward rate guidance for the federal funds rate. And fourth, I would note that the recent turbulence we've seen in emerging markets, they did not view was significant enough to warrant even a mention.
They may see the economy is getting a little bit better, but it's been a rough January. We saw a bad durable goods number, a bad jobless number back in early part of this month, and a lot of volatility in the emerging markets, as you mentioned. Are they playing it a bit too cool?
I think they're looking through the recent poor economic data, clinging to the narrative that the fiscal headwinds are starting to recede. And in spite of the fact that we got tax increases last year and less spending, we still had GDP growth north of 2%. This year, with those fiscal headwinds fading, they're expecting GDP growth north of 3%. And so far, they're sticking to that narrative in spite of the recent slightly weaker economic data.
Is it a big announcement that they say they're going to leave the Fed funds rate unchanged even if unemployment goes below 6.5%?
I think that's one of the challenges for the Fed, and in particular for the new regime under Janet Yellen, is to figure out what they are going to do with the forward rate guidance. Because as you said, the unemployment rate, now at 6.7%, is poised to soon fall below their threshold of 6.5%. And so at that point, they need to decide what they're going to do to strengthen that forward rate guidance. One of the related issues there is, what is the best measure of the amount of slack in the labor market? Is the overall employment rate the best measure of the amount of slack? Our view is that it is not the best measure, and in particular, there's a lot of shadow labor supply in the form of people working part-time for economic reasons and people who are working at a job for which they're overqualified. And I think that leads to excess slack in the labor market, and that's keeping wage growth depressed. And so I think gives the Fed more time to keep the funds rate low before they start seeing inflationary pressures.
All right, the Fed has time. Alas, we do not. Thank you, Bill Irving, and thank you for watching The Street. From New York, I'm Greg Greenberg.